Hi, this is Matt McAleer, Director of Equity Strategies at Cumberland Advisors. March 29th, just after the close. Today I'm joined by John Mousseau, Head of Fixed Income, CEO of Cumberland Advisors. We're going to cover a little bit about the equity markets, but I primarily wanted to spend some time with John today because we've seen a big shakeup in the fixed income markets. He's going to cover some thoughts and ideas of what a 240 10-year means, 240 10-year Treasury versus 3 1/4 back 3 or 4 months ago. Okay, finishing up the month of March on a pretty good note equity-wise. About up 1.5% on the S&P for March, 12.5% for the first quarter. Made up a lot of that fourth quarter. In terms of strength, tech continues to be strong. Saw a nice bounce in biotech. Utilities keeps chugging. Utilities was that warning to people that rates up in that 3 1/4 range probably weren't going to stay there. Utilities started rallying in October, November, and continue to do so. So we'll keep a close eye on that over the next couple of weeks. Bringing in John now. Back in November, John and I discussed the 3 1/4, 320, 3 1/4 10-year Treasury and how John was actively managing our bond portfolios, specifically our muni portfolio and our taxable portfolio. Keep in mind, Cumberland is an active bond manager trying to take advantage of moves in the yield curve. So back in November, that 3 1/4 number was an area that John felt there was a lot of value in.
Sure, thanks, Matt. In the fixed income markets, about 2 or 3 weeks ago, beginning of November, we started at Cumberland to extend our maturities and durations on bonds. And that was the reason why we did some of these moves with a 10-year bond that was approaching a 325, a 30-year bond that was approaching a 345, and municipal bond yields up higher as well, and long municipal bonds around 4 1/4.
John, now that the 10-year has dropped to 240, a vicious rally in price in the bond market, we'd love to get your thoughts.
Thanks, Matt. If you remember when Matt talked about the 325 10-year bond yield, it's important to remember that core inflation then was about 2.2%. We've seen this big rally that Matt talked about. We're down to a 240 on the 10-year bond, or about 280 on the 30-year bond. More importantly, core inflation has only dropped by about 0.1 to 2.1%. So that gap over inflation, which was 1% and more in November, which was a 5-year high post-recession, is now down to essentially 30 basis points. To us, the value that was in the market in November has been reduced today by this large rally in bonds, both in tax-free bonds as well as in taxable bonds. Those long munis that we were buying at 4 1/4%, we're lucky to get 3 1/4 to 3.5% now. What does that mean for an active portfolio manager? That means we're starting to take some profits off the table, particularly on the long end of bonds, positioning stuff a little more down the curve, currying some cash, because we think there's some things at work right now that could possibly raise interest rates down the road, and we want to have some ammunition for it. An example would be, generally speaking, it looks like there's going to be people paying a lot more in taxes this April 15th than they have in the past. This is all because of the SALT provisions in the tax bill, where local property taxes and state income taxes aren't deductible. In the past, when you've had a fair amount of tax selling, it comes out of either bonds or bond funds on the muni side. We think this year, with what will be a particularly higher tax bill, acutely for those in high tax states, we may see some shakeout in the next couple of weeks, and we want to be prepared for that. Another part is the fact that where nobody wanted to own bonds last October, November,
People were calling for 375.
yeah, they said prepare your clients for much higher interest rates. It has totally gone the other way. We're not surprised by it, but boy, there's a lot of people down on the other end of the boat now, and now calling for the fact that the yield curve is inverted between 10 years and 3-month Treasury bills. It's how much longer can that go? It could go longer. We know that the Fed has softened their tone, And I can tell you the one thing the markets are not prepared for at all, if the Fed actually increased rates, because economic activity, which has been decent, continues to move along. So Cumberland has gotten more defensive. We have taken some profits off the table, and we are poised for an opportunity if we get it.
Thank you, Moose, as he's affectionately known here in the office. I hope everyone has a great weekend. We'll keep an eye on the fixed income market again next week, see what the equity markets deliver us, and we will report back to you next Friday. Thanks, Matt.